So thank you, Dr. Ghosh, for joining us and agreeing to address our members. Friends, welcome to this webinar, our monthly series knowledge sharing program. I think in a period, all of us are grappling in terms of inflation, interest rates, the change in liquidity cycle. And I think there are times when macro becomes very important. I believe this is one of those moments in the economic history where we've seen a lot of deluge of liquidity put in by the central bankers. And maybe is it an inflection point where there is going to be a turn in this cycle? I think we have the most eminent person to help us, make some understanding out of this and help us in our day-to-day practice. And I would like to thank Dr. Ghosh for joining us. It is a privilege that we have somebody like him to talk to us. I'll take a few minutes to introduce Dr. Ghosh to all of you. Dr. Soumya Ghosh is currently the Group Chief Economic Advisor of State Bank of India. He has previously worked with Tata AIA, American Express, and ICRA. Dr. Ghosh has been a co-author in a pioneering work to capture payroll data in India for the first time, both formal and informal, and in designing the PM Kisan scheme for farmers and the ECLG scheme for MSC borrowers that has been very successful during the time of the pandemic. Dr. Ghosh has also been involved in designing the Credit Health Guarantee Scheme. Following his report, EPFO and ESIC has started to give out monthly payroll data. Dr. Ghosh is a member of the working group that has been set up by the Government of India for the revision of wholesale price index. He also serves as the chairman of the Indian Banks Association's Economist Group. He is also a member of SEBI Advisory Committee on Research, the Insolvency Board Committee on Research, Economic Advisory Council, the CII and Editorial Advisory Board of Indian Institute of Banking and Finance. Dr. Ghosh is also a member of the governing board of IICA. For 4 successive years ending 2021, Dr. Ghosh has been ranked as one of the best individuals in research in India by Asset magazines. And Dr. Ghosh has completed his doctoral thesis from JNU. I think we could not have had a more illustrious person to help us guide through and, make sense of the current economic environment. And thank you very much, Dr. Ghosh. We're really looking forward to hear you. And thank you very much for joining us. And over to you, sir.
Okay, thank you all of you. Thank you for giving me this opportunity to address all of you. I think today I'll speak a little bit about the current challenges, the economy, and also I'll try to go back to the last 2 years disruption which we have seen. Hopefully we are through with the disruptions. Personally, if you ask me, actually, I keep forgetting wearing my mask most of the time, and almost now I want to make it all the time. So that's one of the most interesting things, and hopefully that will continue for a while, because the economy has now been opened up for the last 3 months. Everything is open and the cases are still hovering in the low 3,000 category. In Maharashtra, there is always a pickup and it goes down, goes up, but I hope that this is basically the end of the pandemic. At least it will remain there, but it is under control. Now, having said that, I think every challenges has opportunities, and the most important thing to note is that if all pandemics, if you have looked into the history of the global events which has been happened once in a lifetime, this has always created opportunities for new companies to come into existence. Microsoft is an example of that. Uber is an example of that. Adobe Acrobat is an example of that. So there are a lot of interesting, a lot of companies have actually come into existence during the pandemic. And I think that the current pandemic also has created several, of course, it has created significant challenges for us, but it has also created opportunities. Some of the opportunities of which are already visible in terms of a significant digital transformation in India. And also the fact that a lot of things which was said about the banking and financial system by noted experts during the pandemic have proved to be incorrect. One of them is the fact that a lot of people said that the banking sector will be witness to 20 trillion bad quality assets after the pandemic broke up. But today, if you look at the restructured advances as per the RBI official data, this number is not more than 1.5 lakh crores. Of course, the credit should go to the banks, the RBI, and all of us, because all of us has issued in an judicious discipline, borrower discipline in the last 2 to 3 years. And I can tell you that I have never seen a strong bank balance sheet ever, because in this crisis, what happened was that the banks went into the crisis and it was completely different from the 2008, because in 2008 when the banks had gone into the crisis, they were not capitalized. This time the banks, when they went into the crisis, they were adequately capitalized, and during the pandemic also they raised capital, so they're even more adequately capitalized. The provisioning coverage ratio of the banks is today close to 90%. If we take the OCA into existence, for our bank it is at 90%. So with that 90% provisioning coverage ratio, with a balance sheet which is, so basically with a balance sheet which is almost as clean, with restructured advances during the pandemic, which is under significantly manageable proportion, I think the best time it is for the banks. And we are proud that we had actually said this in 2020. We had published reports in 2020 August. We had also published reports in November 2020, where we had taken a contrarian position, saying that the banking system is unlikely to see any adverse development, and we are happy that we have been proved correct. So that's the first thing. The second thing is that, and these are all positive development, the second thing is that the corporate sector deleveraging has been significantly higher in the last during the pandemic. If you ask me some of the numbers, some of the total pandemic deleveraging of the banking of the corporates was around 2 trillion. Most of the sectors have deleveraged, so the corporate balance sheet has actually now very strong. Also the fact that taking advantage of the low interest rates during that one, most of the corporates have actually replaced the high debt with low cost debt. If you just low cost debt, and this actually, and that's why you can see that the private investment revival, I think the capacity utilization number which the RBI gives out was at 68%. Last number it was at 72%. I have never seen that manufacturing companies are doling out salary hikes in excess of 15% this year. So we are actually at the cusp of an revival, which is driven by a balance sheet of banks which is clean, by a corporate balance sheet which is also clean. So possibly, I mean, these two, and also the fact that the total investment announcement last year was at 20 trillion. And even if you take 40% of investment announcements are actually, if they realized, that means a number of around 8 lakh crores. So in my sense, I think this the bank balance sheet, corporates, the balance sheets of the corporates and the banks are all remain very strong. And that I think are one of the positive developments which happened during the pandemic. The other positive developments which happened during the pandemic is that the household participation, I will call it an positive development because of some reasons which I'll explain to you. The important point is that the household, the participation in the equity markets actually has significantly increased during the pandemic. We call it a self-fulfilling prophecy. If you look at the equity and mutual fund data which these households have, that number possibly has moved to around 2.5 lakh crores in FY20. In US, this number is around 333 lakh crores. So there is significant opportunity to go for this to go up the ladder, and a lot of people, given the fact that interest rates has been at low levels, including bank deposit rates, have moved to the stock market in anticipation of a better return. So that's why the markets Of course, the markets have been volatile in the last couple of months due to the global development, which I'll come to it after this one. But still, the markets have hold on to levels over levels of 50,000. But here, there could be some corrections in the market in the future. I mean, because oil at 120 with US Fed rate hikes, I think, and as all of you know, that the Nifty was at 18,000 some point back. It went to 17,000. Now it has moved to 16,000. So there is possibility that it will go down from here, because a lower oil prices in the future as US raises interest rates will be an precursor to an possibly and slowdown in demand and global growth. And that could actually push some pressure on the markets in terms of an equity markets in terms of declining. But that's a separate thing which we can discuss it in question answer whenever we have time. But that's one of the possibilities we wanted to do. Now, regarding the other things which I would like to say is that regarding the inflation projections, I think, as all of you know, that inflation globally has now become a scourge. In US, UK, Germany, everywhere you look into the inflation numbers, they're at 30-year and 40-year high. In the Indian context also, the inflation last month inflation number was at 7.8%. But the good thing is that possibly this 7.8% at the current level looks that possibly we may have peaked, even though the inflation numbers during April to September should be around 7% for all the months, for most of the months, if not all. And only in the second month, only in the second half, this number could get down to below to 6.5%, and possibly by the end of March, this number could be closer to 6% or below. So for the inflation front, there will be a gradual decline. But my point over here in the inflation front is a little some interesting insights. As all of you know that the RBI has been raising rates. It has raised rates by 40 basis points in the inter-cycle, off-cycle meet in May. There is going to be another rate hike in the June policy. There could be another rate hike in the August policy, and possibly another rate hike in the October policy. But overall, the total number of rate hikes should not be more than 100 basis points. So basically, we are looking at a repo rate, peak repo rate, which could be in the range of 5.25%. The important point to note over here is that the Reserve Bank of India, we had actually also a meeting with we also meet the RBI, but the important point is that if you look into the interview of the governor today in the Economic Times, you will see a distinct difference in the sense that the governor has also emphasized on growth, which is saying that there also the RBI is equally cognizant about growth. So I think this is a very positive development, and my sense is that the Reserve Bank has tried to calm down expectations in the market of significant amount of rate hikes. Let me point out some of the issues over here. As you know, we now have a transmission mechanism, which is basically instantaneous. So our home loan rate, for example, at 6.70%, which has gone up to which will go up to 7.10% from June. Now, if suppose the RBI raises rates from 4% to say 5.25%, that means 125 basis points. That means the home loan rate will go from 6.70 to 7.95. Take it as 8%. If suppose even if it goes higher, say 8.25 or 8.5%, our aim is at 5.25 to maximum 5.5%. So that means that within a span of 3 months, a household will need to pay an interest rate which is 150 basis points higher than what it was. So if I take that factor into consideration, I think earlier, if you all know, the monetary policy used to have long and variable lags, but this time I think the monetary policy lag will be much shorter and nimble. And if that is the case, the demand could actually significantly course correct after these rate hikes. So that's why I'm saying that the RBI may actually front load the rate hikes in the June policy, August policy, maybe in the October policy, that it quickly reaches the rate of 5.25 or 5.50. And then let's take a call of how the inflation trajectory is going to move forward. Because in the second half, inflation is likely to decline. The other important point is that no government will want to get into an election in a rate increasing cycle beyond 2023. I think the general elections are due in 2024. Also, state elections will also happen in 2023. In 2022 December also there are a couple of state elections. But if I take that factor into account, I think the RBI, the rate hike cycle will actually be quite short this time. If you remember, when Rajan was the governor, his rate hike cycle started in September 2013, and I think it ended in January 2014. There were 3 rate hikes of 2025 basis point, and then it ended. When Dr. Patel was the governor, there were 2 rate hikes of 25 basis points, 6 to 6.5%. And this time, I think the rate hikes, also 1 rate hike has been done. Maybe there could be another 2 to 3 rate hikes, but again, the cycle would be shortened, and possibly the Reserve Bank will try to squeeze in before the election year comes into existence. So that is basically from 2023. And my sense is that the government and the RBI has actually played a quite and sensible way of supporting the economy through pandemic. In the Indian context, I think recently one of the former DGs of RBI, Dr. Acharya, had written a book on the fiscal dominance of the monetary policy in the Indian context. In the Indian, basically the point is that in the Indian context, if you actually plot the monetary and fiscal policy coordination for the last 30 years, say for example, if you take money supply and the fiscal deficit and plot them over a period of 30 years and try to estimate mathematically that what is the correlation between them, we find that it has been statistically insignificant, meaning that fiscal and monetary policy have never worked together. So for example, fiscal policy in the Indian context has always been cyclical, in the sense that whenever the economy goes up, the fiscal policy expands. Whenever the economy declines, the fiscal policy declines. So I think this is one thing which has bothered us, because fiscal policy ideally should always have been counter-cyclical. If we actually look into the history of India's fiscal policy from 1950 till 2020 and plot a graph of fiscal policy expansion and the fiscal policy expansion and this GCF, you will actually find that they move in tandem. So, but this, after the pandemic, I think the best thing has happened that the monetary and fiscal policy has been working in tandem. And recently the RBI has taken the rate hike. The government has also chipped in with several policies which is likely to bring down inflation in control. Our estimates that this number could actually pull down inflation by another 40 basis points. So this is one of the best developments during the policy. So that's why we are a little bit positive about the policy measures which the central bank and the RBI has been taken during the pandemic. Now, regarding the other factors, regarding the exchange rate and the interest rate, I think, just think of these numbers for a minute. I think oil is currently at $120 per barrel. It has been persistently at more than $100 per barrel for the last couple of months. There has been a capital outflow of around 18 billion portfolio capital flows from the Indian markets in this calendar year. Even after that, the rupee is still holding at 76.5 levels, which to me is actually an exceptional performance in the value of the rupee. Ideally, if these are the numbers, then the rupee should have been sitting at more than 80 at this point of time, if I go by the past history. But what the RBI has done has been a smart move. In one of the RBI research actually in 2001 of the research in 2021, the RBI had clearly said that exchange rate, foreign exchange market intervention is now a part of the inflation targeting regime, indicating that the RBI will actually bolster foreign exchange reserves to support a rupee instead of allowing it significantly, instead of depreciating it significantly. And because what happens is the rupee depreciates, is this to pressure on imported inflation, so that pushes inflation higher. So that has been one of the major consideration of the central bank, and that's why the rupee, as you know, the rupee recently went through some little bit of disturbances, but this was mostly because the dollar had reached a 40-year high, and if the dollar reaches 40-year high, any domestic currency will be subject to such amount of pressures. But I think the rupee has performed admirably well. And in the future also, I think the rupee will continue to do well because of this simple policy change which the RBI has done. The RBI has also become very smart now. As you know, the RBI had allowed the rupee to be, traded in the NDF market, which is an onshore market. So as you know, if it's a forward market, so basically, when you intervene in the forward market, it doesn't have any impact on the liquidity or any impact on the reserves doesn't decline. So the domestic market actually follows the NDF market. So what the RBI has been smartly doing is that it has been intervening in the NDF market, and the domestic market is following it, and that is having no no impact on the liquidity and the foreign exchange reserves, and that's actually is also driving the rupee to stability. So this is one strategy change which the central bank has done, and I think this has held them in the good state. Regarding the interest rates, as all of you know, that interest rates, the domestic, the 10-year yields are currently in the excess of 7.3% to 7.35%. Today, the yields have actually hardened by around 6 basis points. There has been a lot of contrarian calls in the market that these 10-year yields could go to 8%, they could go to 8.5%. We believe that yes, there are some upside to the yield movements which is possible. But let me also strike a note of interesting insights over here. As you know, the RBI governor in the past had also said that the CRR cuts has been made, which supports open market operation. The RBI has done a CRR increase of 50 basis points last policy. It is likely to increase the CRR rates in the forthcoming policy. So once they increase this CRR, this impounds reserves from the banking system. And my sense is that these reserves from the banking system may be given out when the RBI does an open market operation in the future so as to cool down yields. If you remember, in 2003 to 8, the RBI did a similar thing. They went for market stabilization bonds and the CRR high, and this time it may not be any different. And my point is that this is going to be a significant development in the form of RBI, because I think in the current crisis, all three are going to has to take the plate. The RBI is already taking the pain in giving higher interest rates on reverse repo park. The government is also taking the pain of paying a higher interest rate on its borrowers, and the banks can actually take the pain of paying of losing a higher amount of opportunity because of the CRR being impounded. And my sense is that 90,000 crores were withdrawn to CRR hikes, 87,000 crores were withdrawn to CRR hikes in the last policy. This number, if it another 100 basis points CRR goes out, so that means that could make the numbers, total numbers could be around 2.75 lakh crores. I think that's a very good amount which the RBI could use a part of that amount for open market operation in the future if the yields need to break up significantly. So therefore, my sense is that yes, there is an upward movement of yields, but don't expect that the yields to move up significantly, because the RBI is concerned about the yield structure. And the other important thing is that this is also a very interesting thing is that if you know, remember, if you just give me 1 minute, there is a call. Just so my sense is that what I was talking about, can you last point?
You were mentioning about that don't expect the yields to move up.
Yes.
much.
So basically, I think the RBI is cognizant, and if you remember last time also, the RBI has actually managed the government borrowing program quite effectively, and managed the borrowing program quite effectively in the sense that what it did is that the government was able to borrow, the state governments and the central government were able to borrow 18 to 20 lakh crores at the lowest possible cost. And the other important thing is that I missed out before the call came, is that there has been now a new change in the circular. The states cannot borrow if they run off significant off-balance sheet liabilities. This has resulted in a lot of states being unable to tap the market. Telangana is one of them. Rajasthan is also one of them. Chhattisgarh, I think if I look into the data, Chhattisgarh is at that time. Andhra Pradesh is also one of them. So if I take all these factors in, that's why you will find that in the first quarter, even though the expectations of the states borrowing was significantly on the higher side, it has actually been on the lower side because states have been unable to borrow. So by default, if the states doesn't borrow from the market, that will also keep the yields lower. That is also one of the reasons that the STL yields have been on the lower side. So if I take both these factors into control, both these factors into consideration, I think that the significant uptick of the yields is actually ruled out. significant
Doctor, you've gone on mute.
just give me 2 minutes. I'll just give a call and I'll just done.
Okay, sir.
I'll just come back in 1 minute. Just give me some work. I'll just come back.
That county is now disconnected.
Till Dr. Ghosh comes back, I think some very interesting points he has already made. And some of it might, at least I thought, counterintuitive. And I think from a positive side, what he highlighted is that the bank balance sheet has never been stronger. You know, it's a very, very positive statement. I think economic growth depends a lot on, how much banks are able to lend, and banks need to be in a very strong position, as he mentions. I think he's also mentioned that corporate balance is back.
Yeah. So basically, so this is basically the issue. So that therefore yield, yes, there will be some upside movement in the yields, but I think that the RBI is cognizant of the yield. And if you go through the interview, the RBI is also cognizant of the growth concerns, the other concerns. So I don't see any reason that why the Reserve Bank of India, why there should be so much fuss about an uptick in the yields. So therefore, yields are unlikely to touch. Some people in the market are saying it will go past 8%, 8.5%. So I don't agree with that. I also don't agree with the fact that rupee will cross 80, and we have been saying this repeatedly. We are and regarding, but the only point of concern. Only point of concern for us is basically, so the only point of concern is that regarding the growth concerns, the Ukraine and the Russian conflict has now lingered on for significantly longer time. All of us were expecting that there should be a swift end to the war by the end of March, but it has not happened. The war has continued. The good thing is that India has limited exports to Ukraine and Russia because that is less than 2%. So therefore, the export impact will not be that much. But as all of you know, the imports in the Ukraine is a significant larger exporter of wheat, It also agricultural commodities. It also Russia is an exporter of palladium, other metals. So that is one of the reasons why food prices in the global market has gone through the roof. India has rightly decided not to export wheat, because I think the wheat total output of the wheat could be around 88 million lakh tons this year, instead of the
Yogesh, can you mute yourself, please?
Sorry.
So that is one of the reasons. So I think that the government has done the correct thing in terms of capping the exports of wheat. It has also capped the exports of sugar. But the steps which the government has done, I think this will have a sobering impact on the inflation trajectory. So overall, if you ask me, I think India has done quite a decent job in terms of managing the current pandemic. And beyond the current pandemic, we are a little bit concerned that the growth is still not broad-based. Our fourth quarter GDP number, which is coming out on the last day of May, is actually tad lower at 3%. And if these growth numbers continues to be low, I think that will continue to put a pressure on the government in terms of more fiscal largesse. The good thing is that there has been the job growth has started to begin. It is now quite strong. In the month of April, and as I said, manufacturing jobs are now also becoming stronger. Overall formal jobs, if you look into the payroll data with the report which we released last year, this year the number has been around 146 lakhs. The first time jobs have been created also significantly. So keeping all these factors into consideration, I think that there are of course some concerns on the Indian economy, but our sense is that I think we are well placed to weather through the current crisis. And I am sure that maybe we'll be able to create more opportunities than challenges in the near future. Of course, that geopolitical challenges will keep on remaining, but take my word that if there is now one talk about a global slowdown or recession, 1 out of 3 people is saying, if that takes the place, oil prices will decline from the current levels. And if the oil prices, and if the war ends today, and if the oil prices starts declining, I think that will be good for all of us. So overall, I think we're on the correct path, and unfortunately, two once in 100-year event. Maybe one was not the pandemic was once in 100-year event. The war may not be once in 100-year event, maybe a once in a 10-year event. Within a span of 2 years have actually significantly put a question mark on the growth story. But if I discuss all these factors and other things, I think the things which India have done during the pandemic, some of the things have actually tested us, has supported us in good times. I'd like to end here, and I'll be very happy to take your questions.
Thank you, Dr. Ghosh, for that very insightful talk. So who would like to lead? Sangeeta, Yogesh, would you like to start with the first question?
Yeah, I'm just sorry. Can you hear me?
Yes.
Okay. Doctor, you were mentioning about the dollar, the rupee stabilizing at the current levels because of the intervention of the smart intervention of the RBI. Do you know, it was stable at 74 for quite some time. Do you now see this stabilizing at the 77.50 levels? Or
yes, it will stabilize between these levels only, and I'll not be surprised if it shows an appreciation bias towards the latter part, maybe after a couple of months. But I think the stabilization level should come at this level as of now.
Oh, appreciation. Okay, that's something that nobody has talked about so far.
No, I can tell you, we have talked about this one in the last also, and we have proved correct. And I don't see any reason that why there may not be an appreciated trend. If the war ends tomorrow, if the capital flows reset, because with an 18 billion capital outflows, with a dollar at 120, rupee still at 77, rupee still at these levels actually is almost a godsend. So I don't see any reason that why there could be a possibility of an trend which is on the positive side in the near future.
That's a very positive thing to hear, Doctor. And my one more question was, you mentioned that in August of 2020, you came out with a report that the banking system will be able to sustain all shocks, contrary to what everybody was saying at that point. Where did that confidence come from?
No, because we are looking into our banking book and we knew that we had adequately covered on the balance sheet. And we also looked into the data. We also looked at the restructuring advances. We also looked into the fact that a large part of the corporates was actually using the moratorium during that time to build up their balance sheet. Of course, in this context, I may like to say that during the pandemic, the large corporates may have gained at the expense of the small corporates, so that we can't deny, that we cannot deny. But the fact is that the balance sheet of the corporates actually has been quite strong during the pandemic, given the fact that interest rates were low, so they have been able to substitute low cost debt with high cost debt, and that could have been, and also building up cash reserves by using the moratorium route. So I think these are some of the reasons which we had mentioned at that point of time, and this actually proved to be correct.
That's right. Thank you, Doctor. Over to you, Dhruv.
Yeah, thanks. Sangeeta?
Doctor, I think you made the day for Yogesh. All those who have children and who are studying abroad, and if you tell them that the dollar is going to depreciate and rupee appreciate, they are very happy about it. Doctor, that means if you think that the rupee is, the interest rates may not go above 8% and growth is coming back, that means it calls for investing in equity.
See, investing in equity means that there is a slight change. There is a slight caution I would like to put over here. I think if you know, the Nifty has moved from 18,000 to 17,000. Now to it is moving in the range of 16,000. Even the equity markets actually has flummoxed us, because at this rate of exceptional rate hikes, I think we expected that the Nifty should have been trending lower. And this is one possibility which you must take into consideration, that there is a possibility that Nifty could actually move down from the current levels. I think it could even move down lower than 15,700, 800, which is a tested. I think there is a possibility that it could go even below that, much below that. I mean, this is a view which we have been holding for a long time, but the markets have been slowly moving towards that direction. But the only good thing over here is that I think the time has now come to invest in specific stocks. For example, recently when the markets, this is my personal experience which I'm saying, recently when the markets corrected, I think one of the stocks which did quite well was ITC. So that was actually acting as a counter-cyclical buffer to the counter-cyclical buffer. So my sense is that instead of waiting for the markets to find a rock bottom, which still has not found in my sense, I think it is better to invest in specific stocks rather than because otherwise what will happen is that you will have an loss of opportunity cost. Because if you say wait for 2 to 3 months to allow the markets to find it level and then you start investing. So instead of that, you can actually take a decision of putting in specific stocks which could give you a better return over a point of time, which is already corrected. Because there are some stocks which are possibly yet to correct, which could take down the value of the index, but there are stocks which have already corrected.
Thank you, Doctor. I'll take some questions which have come up. What is your view on gold for the next 1 to 3 years?
Gold is something which is basically, if you ask me about gold, I think gold prices had gone up significantly. Now they have corrected. So next 2 to 3 years, 1 to 2 years will be difficult to say, but I don't see significant upside to the gold prices. Maybe some amount of upside will be there if for example, the oil prices correct and other things correct. So there could be some amount of uptick in the gold prices towards the latter half of the year. But generally, I think too much of upside I'm not looking into.
Actually, between gold and silver, don't you think, silver would give more appreciation than gold?
No, I agree with that point.
Okay.
Sangeeta, just follow on. So do you think gold, prices also depends on how the dollar?
Yes, obviously. That's the point which I mentioned. So as soon as the dollar started to win, there has been a correction in the gold prices. Earlier gold prices are going down. But the important point is that if there's a slowdown, if there's a global risk of, gold prices will again start increasing from the current levels. So therefore, expect maybe some appreciation in the prices of gold towards the latter part of the year, as there is a destruction of demand because of the rate hikes by the central bank. So that's the point which I wanted to say.
Okay, thank you. Yeah, Sangeeta.
Mr. Suresh is asking that if RBI increases interest rates, immediately all banks, they raise their lending rates, but it is not happening when RBI reduces interest rates to pass on to the borrowers.
No, this is not correct. If you look into the data, in fact, the total, I think this has completely changed. This is a perception in the market, but the reality is absolutely different. As per the RBI data, the total weighted average of the lending rates of the bank had declined by 140 basis points from 2019 February till the rate hike cycle started, and the total amount of weighted reduction in the average lending rate of the banks are 186 basis points. So the transmission actually was much more than the cut in the RBI rate hikes, and basically, I mean, for every bank it has happened. So I think this time the transmission is complete. So there is no reason to believe that the rate hikes has not been passed to the consumers. So that's why the rates were actually at 6.7, 6.5%. They have moved down significantly over the last 1 year or so as the RBI has cut rates. 115 basis points of the cut in repo rate has more than that has been already been transmitted to the banking system, and we have the data with us. So I think that is not correct right now.
Okay. But since you are saying that even all the banks' balance sheets are very good, so do you think that it is time to invest in banks?
It is good, but basically, I think rate sensitive stocks, I think as all of you know, the RBI will raise rates. So that factor also you need to take into consideration. So there could be an outlook that the credit demand may not significantly perk up because of the pickup in demand. So that factor you also need to take into consideration, at least in the short term.
Okay. Thank you very much, Doctor.
So
So
one other question which has come up is, why is there so much gap between the CPI and the WPI? Can you throw some?
I think that is one of the reasons, that basically what is happening is that the entire amount is not passed through to the producer prices, is not getting passed on to the consumer prices, and it's a slow process because corporates don't have that significant pricing, did not have that significant pricing power because of the pandemic. Now they have started to pass on the corporates, pass on that to the consumer prices. One of the examples is the petrol and the prices. Yeah. Now they have again cut. So therefore, again, this will revert. So my sense is that as the pass-through happens, and the gap between the two actually is good for us. If the gap remains, that means the pass-through is not happening. And if the pass-through is not happening, then the corporates actually will take a hit on the margin and the consumers will start to benefit. So I actually see that a good development in hindsight, and I believe that there should be, the gap should actually not be that should not be significantly lower in the future, because that will only talk about corporates passing on the entire benefit to the consumers.
Yes, Rupa.
One question which is just cropped up, Doctor, which talks about saying that would your view be on real estate sector?
No, I think real estate sector, last time, if you ask me, during the pandemic, there has been a lot of investment in the real estate sector because people have taken advantage of the low rates. I think it is still an attractive bet because prices have appreciated in some of these, segments, but it has still not reached that level. And I think that if I look into the household data, I was looking to the data of the household savings today, the household investment in real estate actually declined during 2020-21. So it's still an attractive bet. It's still an attractive bet, but I think that a large part of this attractiveness, may have been taken away because of the significant increase in input cost. But so that is my view. But I still believe that if you want to invest in real estate, you can go ahead and do that. And it is also happening. I think mostly in the luxury segment, there's a lot of buying which has happened, as if my understanding is correct.
Yes, yes. So, doctor, basically in the real estate, the trend has been if the people make a huge amount of wealth during the
Yes.
markets doing very well, then some amount of money.
Yes, of course. So
Real
that is the reason that there is so much interest in the ultra luxury segment. So the interest may not be significantly in the lower category segment, but at least in the ultra luxury segment or lower segment, they are doing quite well.
Yeah. Dhruv, I'll hand it over to you.
Yeah, so coming back to the issue of what you mentioned, the inflation. So what you are very positive on the Indian economy, I believe, from your talk. But what we are witnessing, there's a fast, rising interest rates globally to, fight the inflation. So is that going to lead to stagflation or recession in the Western world?
No, I think the stagflation and recession is the slowdown could be a good one. What the term which I should use for the Indian context is a term which I call slowflation. Basically slow growth and high inflation. So I think that is a better word to say that we are in recession or in stagnation. But the proper way could be, and the term which I could use is actually slowflation. The fact is that, I mean, Fed is going to hike rates, and that is already being reflected in the Indian markets. Capital outflows has been significantly 18, but that is, as I said to you, that's why the extended management became so important. But so just think of a situation and just think of the praise which happened 10 days back when the rupee actually moved from 75 to 77 within a matter of a couple of days. There was a significantly bad praise. So I think if you just think of a situation whereby because of this capital outflows, the rupee also would have started moving downwards. That of course would have created a negative sort of sentiment and a self-fulfilling prophecy of more capital outflows. So while I agree with your fact is that interest rate risk rises, interest rate increases in global central banks will remain a threat. But the Indian context, India will also raise rates maybe by another 100 basis points. But my only point is that inflation rate as of today, if suppose nothing untoward happens, as of today doesn't look that threatening or menacing as like a developed economy does. Of course, it will stay over 7 months till September. For all the months, if not all, at least for all the months, and after September, that is going to decline. But next year also, I think if it comes over a higher base, the numbers will automatically adjust, and then the RBI will have some advantage of trying to moderate the rates. So while I agree with all your points, interest rate increases, there is globally the food, India has done the best thing in banning wheat exports. In fact, there are 27 countries they have banned wheat exports. Some countries like Lebanon have also gone ahead and banned ice cream. So there is of course an looming, I mean the food problem is significantly higher side, but my sense is that we will possibly be able to overcome it in the current year.
So one of the members is asking how serious, in terms of the food shortage, what you mentioned, is it really that some of the countries could be really impacted? I mean, India is not impacted so much because we have our own sort of food production, but are some of the countries?
No, it's a crisis. I think it's a crisis which is unfolding. Yes, there is a globally food shortage is a big issue, and my sense is that the good thing is that India may not have been impacted so much till date with that crisis. But yes, it's a global crisis which is basically assuming threatening proportions. So I agree with the proposition. And if the war continues for even longer, then I think things could get worse also.
And related to the war, I think what you mentioned, oil is at an all-time high. And so the positive is that if the war ends, oil price comes down and that helps us as an economy. But coming to this issue, what we hear that now Russia wants the oil to be settled in ruble or a non-dollar.
That actually we have written about it. I think that actually gives an advantage to the Indian currency system to be, I mean, India has a unique payment system, UPI payment system. Just think, I think if tomorrow, suppose God permits, if there was a conflict, say if India was a part, Indian payment system is so much insulated and built in its own infrastructure. We are unlikely to be, insulated. And also the fact that this digital lending has now, though that is the most important thing to have happened during the pandemic, that our digital landscape has increased so significantly. And this introduction of the RBI digital currency, which could result in an introduction of a wholesale digital currency, because already I think we have some sort of a retail digital currency through the UPI, but wholesale means that whatever the banks hold reserves with the RBI in electronic form. So what could happen is that electronic reserves could be linked to the lending opportunities of the bank. So there could be an immediate real-time credit approval or credit sanction and credit disbursement from the banks to the particular corporate. And this is a good thing. And I think the Indian also has a domestic payment and settle system, which is also quite sound. And my sense is that why not India uses opportunity to settle its payments in Russian ruble? Because after all, if you ask me honestly, there is so much talk about India bringing oil from Russia, but it is actually our oil, because Indian ONGC Videsh has stake in most of the Russian oil fields, if you look into the data. So by that logic, I think why we should not get oil from our own place. So the point I think is it's also an opportunity on the part of the yuan, but dollar has actually lost some of its hegemony in the last couple of years. A large part of the country has been building up reserves in non-traditional, in non-dollar segments. India also has been a part to that. But since 90% of the global trade is still settled in dollars, I don't think that the hegemony of the dollar would go away too quickly, as has been witnessed in the last couple of days.
So does this shift into, dollar versus ruble, does it have impact on the SDF drawing rights, or?
Ideally, the SDF drawing rate should go up, and ruble also has done, and Russia has actually diversified its foreign reserve significantly from 2014, if you look into its currency apart from dollar. So I think it provides an opportunity for the Indian banks and the RBI to see whether a new world order could erupt, whereby the rupee could actually take some amount of prominence. And also the fact that I think this rupee is now prevalent in more than 120 or 30 countries. So India actually has been able to put up its digital infrastructure across boundaries. Although the rupee card is an example of that one. My sense is that over a point of time, maybe the time has now come for India to take advantage of its supremacy in terms of the global diplomacy and push rupee at the center stage of such global diplomacy. I think it's a difficult job, but there is no harm if we want to do that.
So the global diplomacy, there's a question. Is this, are we seeing a precursor to the sort of a third world war? Is the war likely to escalate further? And because you're seeing the war leading to crisis on food crisis, as you mentioned, oil price hike. So some thoughts on that? Any thoughts on how can it worsen the war?
You see, that answer, we are currently in an uncertain world. So so basically I can say that there is an element of uncertainty. So tomorrow, if they, but the way things have moved on in the last couple of months, we have been now witness to this uncertainty, I think, for the last 2 years, because we had this last more than 2 years, March 2020. In fact, from February 2020, the pandemic started. Today, we are sitting in March 2022. So we are living in an uncertain world. We are lived with this uncertain world. The only good thing, which is that if the vaccine uncertainty, if the virus uncertainty comes to an end, which possibly has come to an end, so I think that will be, that's a positive development, because every other country has been witness to multiple waves. I saw a report recently that US is again witnessing increase in infections. So I think India has, I think the Indian vaccine strategy, of course, in the second, there has been some devastation in the second wave, but I think Indian vaccine strategy have allowed the vaccine to travel through the rest of to the population, and that has developed the immunity system of India. But otherwise, remember, otherwise just think of what would have happened if the immunity system was not so strong. I mean, as far as if I take the example of developed economies. So I think we are blessed with all those things, and let's hope that this, whatever you're talking in uncertainty, I don't deny that, but let's hope that at least the uncertainty comes to an end maybe in the next 1 month or so, as the war gets to a logical conclusion. I think the Russia has annexed a large part of these. I think those part of the Ukraine, I was going through one of the stories, and maybe I think even if you remember the US invasion of Gulf, I remember that US have actually started to bomb the Gulf for a significant period of 2 to 3 months before the forces got into Gulf. So, but I think in the case of Russia, I think they have directly got into attack. So maybe we had forgotten that. I mean, we are not war strategists, but maybe we had forgotten that this takes time to annex a country given this unfamiliar domain, and it's 3 months now. So let's hope that we find a logical and quick end to the war. But the only fear is that even after the war, things will take long time to come back to normal, because of the fact that the sanctions will remain. Some of the sanctions will not go through. So that is one part. And the other part is that and decline in oil prices will only only indicate that there is going to be a global slowdown. But as of now, if the Chinese demand comes back, oil prices may not significantly correct from the current levels. So that is so these are threats which you are mentioning. But the only thing is that the RBI is also cognizant. So, but I am not so much afraid that the yields will get up to levels of 850 and like that, because that is actually talking about two extreme levels.
Okay. So I think, I mean, if I was to summarize, what you're saying is optimism, as the saying, optimism is the only realism. I think we all need to be having a positive outlook.
Yes.
And I think, Rupa, I think most of the questions, I think, have
So,
been
Doctor, there is one favorite question which has cropped up, which is the talk of the town, the talk of the whole globe, which is talking about is, what's your view on crypto?
No, crypto, I think my view on crypto is that if you ask me very honestly, I think it's a technology which we should allow to develop, because globally the world is changing. There is no harm in embracing the currency. But I think the Reserve Bank of India has made it very clear that crypto actually leads to money laundering, leads to financial stability. Of course, a part of that is, I don't disagree with that assessment. But my sense is that, I mean, actually, I mean, new technology may always be embraced with, of course, the certainties, and the government also needs to clarify whether there could be, and because as of now, the government has taxed all crypto transactions are to be taxed at the highest income tax bracket. So if you are taxing and transaction, that means you consider that transaction to be a legitimate one. That's not an illegitimate. This is as per the understanding what the government says. So if the transaction was illegal, you should have clearly said it is illegal. But since you are taxing it, so I think you still consider it to be an legal transactions. So I think there should be, maybe the RBI or maybe the government could come out with some clarity. But as of now, I think the government, I mean, will be happy to collect some revenues from these crypto transactions. My sense is that, yes, crypto, and the important point to note in that in 2018, I think the case was fought in the Supreme Court. When the RBI filed a code, the Supreme Court clearly said that, I mean, crypto could be something, I mean, it should be done within the boundaries of regulation. So it had not struck down crypto as an illegitimate currency. So the issue started from there, and we need to appreciate that one. And my sense is that, I mean, invest in crypto, pay taxes, and wait for clarity from the government as long as it doesn't come.
okay.
So it's basically someone's written saying that, you know, how can we accept a currency which is crypto as a currency, where the correction happens in a day by 10 to
So
15.
crypto cannot be a currency. So that's clear. Crypto is, and every instrument when it comes, there is a problem. When if you remember in gold, when it comes, started in 1970 of the dismantling of the Bretton Woods system. We also face the same issues maybe, and every currency alternative, every investment avenues have its problems, but there is also a solution in that one. So this much which I want to say.
Yeah, sure. So I think Dhruv, you can sum it up with your last.
So thank you, Dr. Ghosh. I think it was a very insightful and illuminating session. I think just to reiterate some of the key points, which were the takeaways for me, the pandemic was a crisis, but I think it has been an opportunity in a sense for India as a country, because we really seen what Doctor mentioned, a digital transformation. We have seen the whole banking system come out very strongly from this. And as Doctor pointed out, I think it's a key takeaway that this is one of the best time for the banks, and their balance sheets are the strongest that he has seen. Corporate India has also taken the opportunity to deleverage. They have moved their high cost borrowings to low cost borrowings, which would have helped them. Capacity utilization of corporate India has moved up from 68 to 72%. Household, we are all aware, all of us are the beneficiary of this movement of a greater household participation in the equity markets. We ourselves have seen an all-time high sort of inflows into mutual funds, which we are a direct beneficiary of. I think while world is grappling with very high inflation rates, what Doctor mentioned, 30 to 40-year high rates in USA, UK, and Germany, I think India maybe is in a better position because we have lived through high inflation, and the current inflation rate of maybe 7 to 8% is not that high. And I think the key takeaway from Doctor has been that maybe we are in India seeing the peak of inflation. That could be a very positive sign to take away. We were all worried, I think, about the pace of interest rate hikes and the speed with which rates had risen in the last 6 months. All of us are worried about, how to position our clients' investments in debt. But I think he has sort of indicated that maybe, the view of rates going to 8.5 might not happen. RBI has intervened very well. There is a possibility of RBI taking other steps in terms of CRR hikes and open market operations. And I think another very important takeaway is that for the first time, he mentioned that the government and the RBI, that is both the monetary and fiscal policy, are in sync. That's very positive. And it is also getting reflected in the strength in the currency. I think that's an outcome of our Forex reserves, the RBI's interventions. And I think there are concerns about the war. It's an uncertain time. And the whole issue about the crisis in agriculture. Again, I think what stands out is that India is in a well-placed position. India is likely to sort of benefit from that. And so he's also cautioned, but on the equity market, there is a possibility we must keep in mind of the stock markets moving lower. And I think he's also had positive outlook on the real estate. So all in all, I think the message is very clear that there is an opportunity in crisis. India as a country has, stood out in these difficult circumstances. I think all of us, who are members of FIFA and who are playing a role in this financialization of the savings, I think the message is very clear that we need to get all of our customers more into mutual funds. The outlook is not as bleak as the headlines, suggest. So I think it has been a very, very, very enlightening session. I think a lot of takeaways. So thank you, Doctor. I think You have brought a lot of positiveness to our members, and thank you for coming at such a short notice. You're brilliant as always. Thank you so very much.
Thank you so much, Doctor. Thank you. Thank you.
Thank you.
Thank you.
Thank you.
And with this, we'll end today's session. Thank you, everybody, for participating.
Thank you.
you.
Thank you.